The passage of the 2025 tax law, informally branded One Big Beautiful Bill, marks the most extensive overhaul of the U.S. tax code in nearly a decade. With sweeping changes across personal, business, charitable, and green energy taxation, this law demands strategic attention from every taxpayer, especially business owners, CFOs, and financial advisors. Here's a detailed, action oriented breakdown of the 10 most critical provisions and how to leverage them in 2025. 1. Section 199A deduction, QBID, expanded and recalibrated, the qualified business income deduction, QBID, under Section 199A has long offered up to a 20% deduction on income from pass-through entities. The 2025 revision removes or softens many prior limitations. Income thresholds have been raised significantly, allowing more high-income taxpayers to qualify. Specified service trades or businesses, SSTBs like lawyers, consultants, and financial professionals, face reduced phase-outs. Aggregation rules are simplified, making it easier for business owners with multiple entities to claim full deductions. Strategic action, restructure pass-through entities to maximize QBI qualification. Review reasonable compensation for S corporations to avoid excessive salary allocation. Consider whether your current LLC or S Corp setup needs to be re-evaluated considering the new thresholds. Second, SALT deduction rebalancing, winners and losers. The cap on state and local tax, SALT, deductions previously, $10,000 has been increased significantly, especially for married filing jointly taxpayers. However, there is a geographic redistribution of benefit. Taxpayers in high-income, high-tax states like California, New York, and New Jersey see major relief. Taxpayers in low-tax or no-income tax states see little to no gain from this change. Strategic action. Taxpayers in high SALT states should revisit withholding elections and quarterly payments. Those considering a state domicile change for tax purposes should weigh benefits under the new SALT formula. 3. Curtailment of green energy tax incentives. While past years saw robust tax credits for electric vehicles, solar panels, and energy-efficient upgrades, 2025 significantly narrows eligibility. EV tax credits are limited by income and vehicle cost caps. Solar installation credits have stepped down from 30% to 22% and phase out fully by 2026. Energy-efficient commercial building credits now require certified third-party verification and energy audits. Strategic action. Accelerate any planned eco-investments to complete in 2025. Use professional certification services early to avoid backlog in project approvals. Businesses should reevaluate ESG tax strategies and ROI timelines. Fourth, campaign promises. Realized new targeted exemptions. Several widely discussed campaign promises are made into law. No tax on tips. Tips below $10,000 per year are tax exempt if electronically reported through verified payroll. No tax on overtime. Overtime hours beyond 40 per week are excluded from federal tax for individuals earning under $60,000 per year. Senior tax relief, an expanded standard deduction, and no federal income tax for Social Security recipients with total income below $80,000. Strategic action. Employers must update payroll software and compliance protocols. Retirees should review income streams to ensure they remain under new exemption limits. Service industry businesses need to retrain staff and managers on new tip reporting expectations. 5. Tax rate restructuring. The clock is ticking. The tax brackets for individuals have been reduced by approximately 3 to 5% across the board in 2025. However, many of these cuts are temporary and slated to expire at the end of 2025 unless extended. Capital gains thresholds shift. AMT, Alternative Minimum Tax Exemption, is higher in 2025, then drops. Trust and estate brackets are streamlined for 1 year. Strategic action. Consider accelerating income into 2025, especially bonuses, dividends, or capital gains. Delay large deductions to 2026 when rates are expected to increase. Engage in Roth conversions now to lock in lower tax costs. 6. Bonus depreciation and cost recovery. Optimized cost recovery provisions have been supercharged in 2025. Bonus depreciation returns 100% for most new and used qualified property. Section 179 expensing limits increased to $1.5 million with a $3.5 million phase-out. R&D expenses can now be immediately reduced rather than amortized over 5 years. Manufacturers receive an additional 20% innovation credit on capital investments. Strategic action. Plan equipment and tech investments now, especially for automation and AI. Start R&D documentation protocols early to substantiate expenses. Coordinate acquisitions with your tax team to ensure full qualification. 7. Amended returns, a strategic goldmine. Taxpayers can retroactively amend 2022, 2023, and 2024 returns to apply the new rules where advantageous. Refund windows are extended through December 2025 for qualifying amended returns. Multiple amendments permitted for the same year if tied to separate provisions. Strategic action. Review prior returns for missed deductions, especially under new Section 199A and depreciation rules. Engage your CPA for a full amendment analysis. Some refunds could be substantial. Remember to file amended state returns if your state conforms to federal changes. 8. C corporations regain competitive ground. While pass-through entities enjoy benefits, C corporations have gained a new foothold. 15% tax credit on domestic reinvestment from retained earnings. Enhanced deductions for employer-sponsored education, health plans, and R&D. Reduced penalty thresholds for underpayment of estimated corporate tax. Strategic action. Evaluate whether converting to or from a C Corp provides a net benefit. Ensure domestic investments are properly documented to claim the reinvestment credit. Update fringe benefit offerings to capitalize on new deductions. 9. Charitable contribution timing. Reforms. New provisions make charitable giving more powerful, but also more complex. Cash contributions to public charities are deductible to 80% of AGI, previously 60%. Donor-advised funds, DAFs, must now distribute 15% of annual funds to maintain deduction eligibility. Non-cash donations require new appraisal thresholds and IRS certification. Strategic action. Plan high-value charitable giving with timing in mind. Pre-sale stock gifts. Revisit DAF strategies to ensure compliance and deduction. Use charitable remainder trusts to optimize future giving and income planning. 10. Broad changes to IRS oversight and taxpayer compliance. The law introduces system-wide changes in how the IRS engages with taxpayers. Digital audits are expanding with AI-based anomaly detection. Tax-exempt organizations must meet new financial transparency thresholds. Fringe benefits, such as employer meals, transportation subsidies, and remote stipends are now capped or subject to taxation. Strategic action. Prepare for possible electronic audits. Organize and digitize records. Nonprofits should review board governance, executive compensation, and 990 filings. Businesses offering remote work benefits must track and report these clearly. Final thoughts. The 2025 tax law represents both opportunity and challenge. The changes favor those who plan early, act decisively, and coordinate closely with their CPA or financial advisor. The best strategies for 2025 will be obsolete in 2026. So timing, structure, and documentation are everything.